Everybody wants to invest in the next Uber or Airbnb or Palantir or SpaceX before everyone knows about them. But venture capital, VC, one of the sexiest buzzwords out there, the thing that makes those opportunities possible is still completely misunderstood by most investors. And today I'm going to break it all down in plain English, what venture capital actually is, how it works, and how you can invest in it responsibly. Now, by the end of this video, you're going to know exactly how the ultra wealthy use venture capital to multiply their wealth and how you can start accessing it too. Venture capital, or VC, is a form of private equity that focuses on early stage companies, startups that need capital to grow. Typically, these are companies that have a great idea. And in exchange for that capital, VC or venture capital investors receive equity ownership or a stake in that company that has that great idea. If that company gets acquired or goes public down the road, the investors share in all that upside. So you can kind of think of it as Shark Tank, but with much, much bigger ideas, much larger checks, and much more due diligence. So, it begs the question, why do the ultra wealthy love venture capital so much? Number one, there is asymmetric upside. So, let's say you invest in 10 startups. 7 of them might go to zero. You might lose your total investment. 2 give you modest returns, and 1 of them hits a home run. Easily 10x, 20x, maybe even, and quite possibly 100x or more. So that one winner can more than pay for all the losses. That is the power law of venture capital. The issue with that is you have to be comfortable failing. You are going to lose a lot, but it's those big wins that are going to help you along the way. Number 2, access to innovation. The great thing, the cool thing about venture capital is it allows you to invest in the future before the public ever gets a chance, before the public might even know what that opportunity is. You are not buying after everybody knows about the company. You are getting in before the story is ever told. Number 3, it acts as a portfolio amplifier. So if you think about it, the wealthy, they're not replacing their core investment holdings with venture capital. They're not selling Apple or Nvidia or General Mills or whatever their stock holdings are to buy venture capital. They're carving out a slice of their portfolio to really go on offense. So used wisely, venture capital adds optionality. It is the sliver of your portfolio where those moonshots live, where you can get a 10x, 100x return. A lot of fun, but you have to be prepared for the wild ride that comes along. All right, so here's the important question. How do you actually get in the game? Well, there's really 3 main ways to do it. Number 1 is angel investing. So that is direct startup investments. You invest directly in early stage companies, often through maybe your personal connections, maybe an accelerator, or maybe on platforms like AngelList. These tend to be higher risk, potentially higher reward, but you are doing the due diligence by yourself. You need deal flow, you need time, you need the stomach to lose everything that you invest. And probably most importantly, you need to have a good sense for whether or not the idea that they have is ever going to pan out. Second way is through venture capital funds. And this is really the most popular model. It's kind of the classic model. You commit capital to a fund that invests across maybe 20 to 30 different startups. It's curated, it's put together, it's packaged up, it's managed, it's diversified. So you are going to have some losers in there, but you're going to have some big winners as well. The diversification for you is huge. You now have an opportunity to hold 20 to 30 different companies, of which, yes, some are going to fail, but some of them are going to be absolute home runs, grand slams. And what it does is it gives you professional grade opportunities that you can invest in with your money without you having to actually do the due diligence and pick the companies with the financial forecast that you think have a good chance of coming to life. But it's also going to be illiquid, and minimums often start at least 250 grand, some are $1 million or more. And you don't see returns for 7 to 10 years. And fees are high. They're usually 2 and 20. So that's a 2% annual management fee and 20% of profits. Now, the great thing is that partnering with a firm like ours allows clients to get in at lower minimums than the classic $250K or $1 million minimum, since all of our clients combined far exceed the fund's minimums. In a venture capital fund, we may have $10, $20 million of client funds that are actually investing in these things. So there is no $250,000 or $1 million hurdle anymore for our clients. The third way is via access platforms. So, today we've got platforms like AngelList, Fundrise via the VC arm, and select advisory firms across the country that may offer lower minimum access to top-tier venture capital funds. Think maybe $25,000 or $50,000 to get started, and you still get all the broad diversification and professional oversight just at a lower minimum to get in. Now, let's be honest. Venture capital, VC, it is certainly not for everyone. Number one, it's illiquid. You're not going to get your money back whenever you want it. You're not going to get it back tomorrow. You're not going to get it back next month, next quarter. This is a long-term commitment, so you have to size it appropriately. Number two, it's risky. You have to get comfortable with failure because most startups fail. And you're going to be relying on those few home runs and grand slams that you hit along the way to really carry the load. The third thing is it's long-term. Patience isn't optional. You have to be patient. It's going to take you 7 to 10 years to see any benefit at all. Just think about it. When a company comes up with a great idea, how long does it take for that company to become profitable? Think about Facebook when it came out. Even when it IPO'd, the company still wasn't making any money. All they had was an idea, and people continued to buy into the idea. So it'll take a while, and you have to be patient. And the fourth thing is VC investing is completely uneven. Even among funds, returns are wildly inconsistent. You get some that are great, some that are really bad, and then some kind of dispersed along the way. And look, if you think about it, venture capital, it's high risk, it's high variance. That's why it should only be a small strategic slice of a well-diversified portfolio. 1%, 3%, 5%. So you really need to make sure it is a disciplined, prudent slice of the pie. If you are a qualified purchaser with at least $5 million in assets and your core portfolio is already dialed in, venture capital is probably worth taking a look at and actually exploring. If you're in that maybe $1 to $5 million range, there are certainly ways for you to add it if you do it in a prudent manner. You're not adding venture capital because it's safe. You're not adding venture capital because it's easy. You're adding venture capital because it gives you access to innovation and the upside that the public markets will never offer. And just remember, it's not about betting the farm. It's about planting seeds, and one of them might just change your entire financial future. If you want to explore how venture capital fits into a high net worth investment strategy, subscribe to this channel. Make sure you like the video. I cover how the ultra wealthy actually build wealth every single week. And if you want access to vetted venture opportunities through our firm, drop a comment or DM me the word venture and I'll get in touch.